Africa's two biggest oil producers, Nigeria and Angola, are on a contrasting debt trajectory, with Nigeria's ballooning debt, while Angola is seeing a fall in its debt, according to the World Bank. This was disclosed in the World Bank's Africa Pulse report, which is a biannual analysis of the near-term macroeconomic outlook for the region, published around the World Bank IMF spring and annual meetings each April and October. Each issue also includes a special focus on a particular development challenge that is shaping Africa's economic future, and that challenge for the World Bank for Nigeria is on debts. Here's an excerpt from that report, where the World Bank says, and here's an excerpt: public debt in Nigeria is a concern. The combination of low production in the oil industry and unsustainable subsidies, that's fuel subsidies, is one of the main obstacles to attaining debt sustainability. That's something that the next administration in 2023 is going to have to face. According to the African Development Bank's AFDB 2021 report, Egypt, Nigeria, Kenya, and South Africa account for about a third of Africa's startup incubators and accelerators, and they receive about 80% of foreign direct investment into those four nations there, particularly dominant on the African continent. Again, that's from the AFDB's 2021 report. Affectionately refer to them as the Big Four. Also, the 7th edition of Disrupt Africa's African Tech Startups Funding Report revealed that startups in the Big Four raised a combined $1.9 billion in 2021, about 92% of the overall total investments raised in Africa for that year. And that's with respect to startup funding for accelerators and incubators. So, question is, what makes a startup backable, and how can startups in other African nations outside of the Big Four, how can they compete? Joining us from Cape Town, Luke Mostert. He is the head of investments at Future Africa. Luke, good afternoon to you. Thank you so much for joining us. You had a very popular Twitter thread where you were talking about what makes a VC backable. Can you share some more information on, I guess, the returns expected from venture capitals that invest in the continent?
Thanks so much, Rotis, for having me here today. Yeah, sure. Happy to elaborate. I think first and foremost, the reason I wrote this post was to help startup founders with the knowledge they need to understand exactly the challenges that investors, venture capital investors specifically on the continent face, or globally, in terms of how to assess returns and get returns on their capital. Because at the end of the day, venture capitals themselves are also pitching to limited partners in their funds and have to attain certain returns in order to continue raising capital and continue to keep their businesses alive.
Can you explain in a sentence what a venture capital backable startup is?
Sure thing. Yeah. So a venture capital backable startup, as per my definition, is one that has the potential, if things go well, so according to plan, to return the VC's entire fund. I'm happy to elaborate on this.
Yes, go ahead, please. Can you break it down for us?
Sure thing. So, so let's just assume that a VC has a $10 million total fund size, which is, I guess, quite a common fund size in African VC. If a venture capital fund with a $10 million fund size is doing $200,000 checks, in order for that $200,000 to return the entire fund, it would have to multiply 50x. 200,000 times by 50 is equal to 10 million. But unfortunately, that's not factoring in the dilution that's going to occur on the startup rounds as they move ahead. So each time a startup raises an additional round of funding, all the existing shareholders, the founders and the investors, are going to be diluted an additional 20%. With this in mind, the investors need to factor in additional returns for their capital. So say a pre-seed fund like Future Africa invests at a very early stage, the first institutional round. The seed round, the Series A round, and the Series B round will each dilute the founders and investors' capital an additional 20%. Therefore, instead of requiring a 50x return on the capital, this now moves up to 86 times return in order to return the $10 million fund that we used in this example. So if we factor this into an example for you guys to understand, if the startup came at a $5 million valuation, $5 million times by 86x means that the startup needs to exit through an acquisition or an IPO for 430 million in this instance. 5 million times by 86. With this in mind, this is obviously a significant challenge, but VCs are only expecting this to happen with one or two investments in the entire portfolio, and thus are really hedging against most of them failing and the real extreme outliers, as I used in my example, succeeding. But more concretely, what does this mean for founders pitching to VCs? Well, they need to pitch a startup that has $430 million exit in its horizon, 10-year horizons, particularly in terms of how VC funds function. And if we look at a $430 million exit, the company's probably going to need to operate on a revenue to exit multiple of what's typically around 10x for software businesses, which means they need to achieve $43 million in revenue annually by, say, year 10. If we then extrapolate this one final step, that would equate to if a business sells software subscriptions for $1,000 a month or $1,000 a year, then this would be 43,000 businesses. So how does the startup founder show investors that within 10 years he can reach 43,000 paying customers at $1,000 each?
That's the challenge. There's a I think there was a image that you shared on Twitter, the VC quote unquote power law. Can you explain, I guess how that works? We can put that up for our viewers to take a look. Yeah, there it is, the venture capital power law, and we've got the chart showing the outliers and where the vast majority of the funds that are captured by, well, supported by VCs, where they land. So we've got the mean, I guess, like the average. Can you explain this chart for us?
Yeah, sure thing, Rotis. So the power law really fundamentally plays on something that people are actually more familiar with, something called the Pareto principle. And what the Pareto principle states in typical terms, now this is generalizing it for all outcomes, is that 80% of results come from 20% of causes. So it's like if you want to gain big muscles, you work out and maybe your diet plays 20% of the inputs, but results in 80% of the outputs, some people may argue. So this is similar in many spheres of life, but particularly true in venture capital. And in venture capital, the 80-20 principle is actually slightly more extreme than that. It's probably closer to the 95-5 principle, even maybe the 99% 1 principle. In other words, 1% of the inputs, like in the Y Combinator example, which is the world's most famous accelerator, often end up contributing disproportionate amounts of the outputs, upwards of 95 to 99%. And in this sense, VCs are really only hoping on one or two portfolio companies returning the bulk of the fund.
Wow.
So how this plays out on the chart here is in a principle called the power law, which was coined by Sebastian Mallaby in his book by the same name. And the power law effect is this kind of exponential returns from minute inputs that the Pareto principle also plays on. And as it shows on the graph here, extreme outliers in the fund are very infrequent, as seen on the y-axis, but contribute exponential returns in terms of startup valuation, as seen on the x-axis. In fact, I would argue that this chart here is probably not drawn to scale. The extreme outliers section here should actually be a lot further along to the right than it is in this instance. Indicating that the extreme outliers do return a significant portion more than the mean startups, which are kind of returning probably slightly less than what was put into them.
All right. Now, I want to quickly ask you, because we've got about a minute to go. As far as the global economic downturn, how has this impacted startup valuation, startup funding for this year going into 2023? Briefly, if you can.
Yeah, sure. So startup funding has probably been taken about a 30 to 40% hit in terms of valuations on the continent. So startups that were raising at a $10 million valuation last year are probably raising closer to a $6 or $7 million valuation in 2022. And the reason for this is pretty simple. It's the same reason emerging market commodities have taken a hit, emerging market FX has taken a hit, and that's that foreign investors are doubling down on safer investments such as bonds and moving away from riskier assets such as commodities, even more so venture capital, and even more so things like cryptocurrencies are really taking the biggest hit here.
Wow, Luke, I really appreciate you joining us to talk about this. There's a whole lot more that we could have touched on, but we've run out of time. Luke Mostert, Head of Investments at Future Africa, thank you so much for joining us to discuss. So we appreciate your time.